So the question we want to look at is why we don't ban the negative numbers. They cause all these problems, they risk runs on the bank, they risk people losing their life savings, they require all this legislation, all this difficulty. So why don't we just ban them? Why don't we just say you can only spend money that you've earned effectively? Okay, well, the whole point of the negative numbers is they allow people to spend money they have not yet earned. Now that might seem a bit silly, but it's actually essential to enable entrepreneurs to start businesses, as most businesses use money first before they start making money. Okay, so you do need to be able to borrow, which is what the negative numbers are about. You need to be able to borrow in order to invest, in order to create wealth in the long run. Okay, so as we've already seen, this is risky for the bank and it's risky for the economy as a whole. So there are various parties regulating it to make sure it's done in the right way. However, if this is too risky, and it often is too risky, and often banks, if you try and borrow money to start a business, often they'll say no unless you can remortgage your house to do it. So it's not often actually that practical way of raising money for a business, but fortunately there are other ways of businesses raising finance. And this is really what the whole topic of corporate finance is all about. Okay, the whole topic of corporate finance is how businesses raise money in order to invest, in order to get businesses moving, in order to make money. And there are two fundamental types of ways they can raise money. They can issue bonds or they can issue shares. Okay, so first of all, the bond. A corporate bond is an asset which companies sell to investors, and that asset is the right to receive certain amounts of money, which are coupon payments and redemption payments. Okay, so if you own a house, you own the physical bricks and mortars, the land it's built. If you own a corporate bond, you own the right to receive certain cash payments at certain points in time. Okay, and these tend to be big issues when a corporate bond is issued. It is many months of work for the people in the corporate finance department, the people in the treasury at the business, the people in the finance department, and they'll be working alongside an investment bank which actually does a lot of the work in terms of putting the bonds out into the market, because it's the investment bank that knows who the investors are. They know the fund managers, people like that, the other banks who will be looking to buy these sorts of corporate bonds. Because a corporate bond is sold by a business to raise money, but it's sold to investors who are savers, who are looking to actually receive these coupon payments and redemption payments in the future. Okay, what does this corporate bond look like? Okay, well, typically a corporate bond will be a set of coupon payments, cash flows, and then a redemption payment at the end of a certain period of time. Corporate bonds tend to be this sort of period, about 4 years is fairly typical. They tend to have a coupon payment every 6 months, tend to have twice a year. Then the redemption payment at the end will be typically sort of one coupon payment plus the amount of actual cash. That probably should say, that would be better if that said £4 rather than £5, realistically. Because typically the last payment is the coupon payment plus the redemption payment. The redemption payment is typically 100, because that's just culturally how bonds tend to be issued. They tend to be issued in units of par value 100. So this is what you own. If you own this corporate bond, you own the right to receive each of these cash flows. Okay, but there's two things about, you can't just say 5 plus 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 104 is the value of the corporate bond. Okay, because these payments are made in the future, and also there is a possibility that this business will go bankrupt and will not be able to meet these bond payments. So the assessment of how much this corporate bond is worth, both from the point of view of the business selling it and from the investors buying it, requires a little bit of mathematics. Okay, so the fundamental question when we look at how much something is worth is how much would you need to put in the bank now to make all the payments under the bond? Okay, so what are the payments under this bond? Okay, if you put £120 in the bank now and the interest rate is 4%, then in 1 year you'll have 120 times 1.04 equals 124.8. Just zoom in on that. Okay, 1 year you'll have 120 times 1.04. In 2 years you'll have 120 times 1.04 squared. In 6 months, you'll have 120 times 1.04 to the power of a half equals 122.38. That is fundamentally how compound interest works. Okay, so what is present value? Well, present value is the other way around. So the present, instead of putting £100 in the bank now and saying what is it in 2 years, you say if I'm going to receive £100 in 2 years' time, and remember this corporate bond, that's how it works basically, because the corporate bond we're saying you're going to receive these payments in the future. Okay, so the present value of the payment of 100 in 2 years' time is the amount of money I have to put in the bank now so that it will be worth £100 in 2 years' time. So we simply change the subject to the formula, and we say, instead of saying 100 times 1.04 squared, we say 100 divided by 1.04 squared, because £92.46 in the bank now, receiving interest of 4% for 2 years, will be worth £100 in 2 years' time. So the present value of £100 in 2 years' time is £92.46 now. Or in other words, if somebody offers to either give you £100 in 2 years' time or £92.46 now, you should be indifferent between the two. So what about the present value of the bond? Well, all we have to do for the present value of the bond is say, well, we've got lots of cash flows. Okay, we've got a £5, a £5, a £5, a £5, a £5, etc. All these different £5 in the future, and they're all paid at certain points in time in the future, so they all have values which we say we discount back. So the first payment is £5, first coupon payment is £5 in half a year's time, and the interest rate is 4%. So the value of that payment is 5 divided by 1.04 to the power of 0.5. The next payment is in a year's time. It's also £5, and the interest rate is still 4%. So we add 5 over 1.04 to the power of 1, and so on throughout this calculation until the last payment. And that's what the value of the bond is. We just add up these payments, and that is the value of the bond. Well, that's the first order simple understanding of the value of the bond. But we come on to various questions then. How do we know the interest rate is 4%? And the answer is we don't know the interest rate is 4%, okay, but we effectively work that back from the price. Okay, so once a bond has been issued, we can see the price it trades at in the market. So if this bond were issued, this bond we've just looked at, okay, £5 every 6 months, so it's going to be worth more than £100 because we're getting £10 a year on this bond, basically. So it might be worth, say, £120. And what happens is different investors will come to different views about how much the bond is worth. Okay, and then the market price will emerge from people buying and selling the bond. Okay, so once a bond has been issued, we can see the price it trades at because the market price produces the price in the market. We then do the calculation backwards to work out the interest rate, or what we call the yield for the individual bond. So what we say is, we go back to our original calculation here, the value of the bond, and we say, well, actually, this is equal to here what the price actually is in the market. And then we say, we then try and find the value here. Instead of 1.04, we try and find whatever value here will allow us to solve that equation and to therefore produce the value of the bond. Okay, so the point is about this, the information you actually have as factually is what the coupon payments actually are, the 5, the 5, the 5, the 104, okay, and the actual price of the bond is the factual information you have, and then that enables you to work out what the interest rate is on the bond itself. Okay, it might be worth having a look at an example calculation, then just actually doing that in Excel and seeing how that actually works in practice. So here I have an Excel spreadsheet, and I'm going to put in different time periods at which I've received coupon payments or redemption payment, and I'm going to receive coupon payments of 5 there, then 104 there. Okay, and I'm going to say what is the value of this bond. Okay, so these are the payments. This is the present value. So the present value here is equal to this value divided by 1 plus interest, okay, to the power of the time period. Okay, so I need to put in my interest rate, which I'll put in as 4% initially. Okay, if I now drag that down, I get the value, the present value of each of those payments. And you notice the further into the future I go, the less the value of the payment is. And the total present value equals sum of those values. Okay, so if interest rates are 4%, the present value of this bond is 121.284. But what the general facts we have, we will generally know what the payments are because they are defined by the bond, and we will know what the price is because the market is trading the bond at that price because people are buying and selling it. What we don't know is what the interest rate is on the bond. So we do the calculation backwards, and we go for goal seek, and we set this cell to whatever the price of the bond actually is. Supposing this bond is actually trading at 110, and we're going to change this cell here, okay, so as to get this cell to be 110. And there we go, and it turns out, let's do that again because I just lost it. Set cell that to value 110 by changing that cell. Okay, so this value then is 6.99%. Okay, so that's how we do the maths. And let's go back to our presentation. And that's why what we've got here is we're saying that we do the calculation backwards to work out the interest rate for the individual bond. Now, this bond we've just looked at, which has produced 7% return, the reason why bonds produce different rates of return is because people have different perceptions about how likely they are to default. Okay, so if we look at our original bond here, if this was a bond from a very secure company, you would pay more for it. You might pay £120 for this bond if it was, say, from a Glaxo or a Vodafone or a very secure company. If it was from a less secure company, there's more chance that it defaults. Okay, so you pay less for it. If you pay less for it, then when you do the maths, when you do the spreadsheet here, okay, you get a higher number up here. So supposing we paid 130 for it, and we did the maths again, okay, supposing we paid 130 for this bond, we would see that the interest rate implied was much, much lower. And so you can see the more you're prepared to pay for the bond, the lower the implied interest rate is. So what that tells us is the higher the interest rate, the less confidence the market has in this bond. And so the more, in a sense, what you're saying is the less confidence you have that a company will be able to pay its payments, the more interest you want to compensate you for that risk. So that is partly the job of the investors. The investors have to decide how much interest the bond should pay. They need to decide how risky they think the borrower is, and on the basis of that they decide how much interest they should pay, and they then decide how much they're prepared to pay for the bond. So the more risky the company is, the more interest investors will want to receive on the bond. Okay, and that is the essence of what a corporate bond is. So the other thing we can do is issue shares, the other way of raising money. The thing with corporate bonds, before we move on to shares, is the company still owns all the shares. So if you set up a business and you raise capital by issuing corporate bonds, you still own the whole business. The other thing you can do is issue shares, and if you issue shares, you actually sell a share of the business. Okay, so you're not just issuing shares here, you're actually selling a share of the business to investors. So this means that investors get to buy a share of the ownership of the company. And once they own the company, they can actually vote on company matters. They are part of the management of the company. They can actually decide how the company is run. And shareholders can also make a profit by selling their shares at a higher price or by receiving dividend payments from the company. Now the dividend payment is just the profit. When the company makes a profit, it pays a dividend, and that dividend is the reward the shareholders get for having bought the shares in the first place. So the value of shares can be considered by the dividend discount model, which is basically a way of adding up all the dividends and discounting them back and working out how much the thing is actually worth. So what we do in the dividend discount model, we assume that shares will pay dividends forever, the rate of increase of the dividends can be known in advance, and the value of shares can be calculated by discounting the dividends at an appropriate rate of return. Okay. All these assumptions are essentially wrong, but it's very, very difficult to value shares because you don't know how long the company's going to last for, whether dividends will increase at a given rate or not, whether they'll increase a lot faster or a lot slower. You don't know whether the market's perception of what the dividends are going to be will change, and therefore the price will go up or down. So these assumptions are very, very weak assumptions, but they allow some way of calculating the price of a share, but because they're very uncertain assumptions, the price of shares is very volatile. That is just part of the nature of how markets work. So really that's the issue. Let's just zoom out to sort of see the whole corporate finance issue. So that really is the issue with corporate finance. I mean, there's a huge amount more to it when you get into all the accounting and all that sort of stuff. But in essence, corporate finance is these two issues. Do you issue bonds? Do you raise money through issuing bonds, or do you raise money through issuing shares? There's all sorts of other issues then, like how you decide what your dividend policy is. Because paying dividends, if you've issued shares, is a matter of discretion. You choose as a company how much to pay. You're not forced to pay a given amount, more than the given amount or less than the given amount. You can choose what you actually pay. So there's a huge amount of strategy and tactics around making that decision. For example, if you cut dividends, the market will see that as a bad sign and will typically sell off the shares, and the share price will fall. So that's a real problem, because if you want to raise more money by selling shares, the shares are then worth less money. You'd have to sell more shares to raise the same amount of money. Also, many of the directors' bonuses will be based on the share price, and they don't want the share price to go down. There's all those sorts of issues to consider. So it's a very, very complicated area, and we've really just touched on the surface here. So having decided what the different ways are that companies can issue debt or different types of asset to raise capital, we then need to decide how do investors decide which one to buy. Okay, and I think we'll make that the subject of the next video.